Live, good to go.
Fantastic. Good afternoon. It is the meeting for the Town of Dewey Beach Investment Committee meeting. Today is February the 8th. It's 5:02 p.m. Let's first begin with a roll call of the members of the committee. Brian Prevor, Chair. The other committee members introduce themselves.
Barney Kraus.
Suzanne Evans.
Do we have any others? Looks like we've got 3, 2 in person, so we have a sufficient quorum to proceed. We'll go on to the first item on the agenda. First item is to adopt the agenda, which is posted on the town website, available for viewing. Do I have a motion to adopt the agenda?
Motion.
Motion.
Second?
Second.
All right, all in favor say aye.
Aye.
It's unanimous. That passes. We'll move on to the next item on the agenda. Public comments. Do we have any public comments?
Not looking like it.
Hearing none, we'll move on to meeting minutes, which also are available, posted on the town website. Meeting minutes were available for review. Do any of the committee members have any comments on the minutes of the past meeting from December 7th? All right, hearing none. Do we have a motion to adopt the meeting minutes from our prior meeting?
Motion.
Do we have a second? All in favor? Aye.
Aye.
It's unanimous, passes. We've approved those minutes. Next item on the agenda would be a presentation and discussion from town manager concerning the financial needs and budget of the town. Bill, if you don't mind.
Yeah, thank you, Mr. Chair. So as we put out in our newsletter yesterday, we are proceeding with the budget for 2025. Finance Director Sheena Hall has done a good job putting it together this year, balancing a lot of different expenditures, and between the Budget and Finance Committee and the workshop we had with the commissioners last month, coming up with ways to cover those expenditures with revenues. That said, I think the town—
Bill, if I can just interrupt you I'm sorry, for 1 second. I just want to note for the record that Dennis Trencher, another committee member, has joined us as well.
Sorry, it took me a while to get in.
No trouble at all. Sorry, Bill. Go ahead.
That's okay. So I think with the new leadership in the police department, some of the initiatives they have there that deal with public safety, the addition of 3 full-time police officers, we have budgeted for that. So I think, you know, the expenditures have gone up slightly. And our revenues from transfer tax, accommodations tax, and hotel tax has kind of, if I could say, Sheena, flattened. They're not gaining as they were during COVID and even after COVID, how they jumped up the first year after that. But overall, we are pretty good shape. I think that, you know, the general fund policy that Commissioner Persinger worked on, you know, keeping half of the budget's expenditures at the ready during the year has worked out so far okay, and also having the 90-day fund available, keeping up with both of those, and at the same time pulling out set-asides for all the different things. So Sheena's done a really good job of keeping all the balls in the air.
Fantastic. Any questions or comments from the committee? And I should note for the record, Michael Schaefer, another committee member, has joined as well. So we have the full complement today. Any questions or comments from the committee?
No.
And any questions or comments from others present today? Our commissioner liaison?
No.
Looks like I see Commissioner Persinger as well on. Okay, very well. On to the next item, which is the star of our show, Dominic. We'd be grateful for your presentation regarding the portfolio of Brown Advisory.
Thank you. Appreciate it. And good evening, everyone. I will go ahead. I believe this report was posted, but talk through kind of year-end numbers. Let me just go ahead and share the screen. Okay. And perfect. Okay. So overall, account balances across all the funds under our management as of 12/31 were 6.8, just north of 6.8 million. Again, we break this down into three buckets. We have three different mandates. So we have the long-term beach replenishment fund, which has certainly a longer term investment time horizon with equities and fixed income. And then we have the two short term. So we have the general fund short term and then the beach replenishment short term. Both of those two have a separate mandate from the long-term beach replenishment fund. So we'll go ahead and look at each of those three buckets. So first, the beach replenishment long fund, top left performance. So ending 12/31 of 23, the portfolio net of all fees was up 11.3% relative to the blended benchmark of 9.3. That brings us now to inception to date since 2015, portfolio performance of 3.4% annualized over that time period, ahead of our blended benchmark of 3.2%. Top right is our asset allocation and how things are allocated. So targets are in line with the investment policy statement of the town. So we are, a little light on fixed income, a little heavier on U.S. large cap, and roughly in line across the other asset classes. Overall, if you look at the bottom left, since inception, we have it kind of broken out. So income and then market value gain. So about 633,000 in market value gain since inception, and roughly 750,000 in income and capital gains generated from the portfolio. So as we look at if we look at how we've done kind of on a investment by investment basis within the long fund, Flex Equity, which is the main, essentially the main U.S. large cap equity portfolio here, 2023 was up 35.4% relative to the S&P 500 that was up 26.3%. Up 13.4% on the quarter. Our small cap fund was kind of roughly in line on the quarter and ahead by about 100 basis points, or less than 100 basis points on the trailing 12 years. So, really a timing issue. I mean, for to have negative performance, but still relative to its blended, relative to its benchmark is still ahead by roughly 1%. Global leaders up 26.2% on the year, 22 relative to its benchmark. The MSCI All Country World Index up 22.2, and then the Emerging Market Select Fund up 10.7 relative to its benchmark at 9.8. So across the board, our managers and we did make a change, added Voya Intermediate Bond Fund, which was up. We added that kind of at the sometime in September, and since we invested there, up 7.1%. So actually getting some good returns out of our bond funds, as what we'll show, and really the main reason for that is just kind of the move in interest rates, really kind of helped, just really buoy those returns in bonds, which is nice to have that part of the portfolio, given that it's 70% of the portfolio. To be able to get a good positive return is certainly helpful to performance. Kind of just the overall assets. So we look at the short fund, beach replenishment fund, 40% in kind of cash and fixed income, 40% in cash and T-bills, and then 60% in fixed income, up 5.8% on the year, 4.9% on the quarter. And then the general fund up 6.8% on the year, and allocated essentially the same way. So 40% to T-bills, and then the remainder in bonds. So that's overall performance, and I kind of go over the economic overview, but I figure I'll pause there and just see if anyone has any questions around performance that you would like to discuss.
I'll start it off. It's a common refrain these days with you, Dominic. I think terrific job. I look at the long fund trailing 12 months. You beat all your benchmarks, and that's not easy to do. So kudos, and same for the short-term fund. It looks like it's performing quite well. It's performing up to snuff. So all good. Any questions, comments from the others on the committee?
No.
I think one question for you, Dominic, would just be, is there anything you would recommend making a change with, or just stay the course?
Yeah, I mean, I think overall, likely stay the course. We're certainly, as you saw, U.S. large cap kind of getting a bit overweight. I think we feel really good kind of about the makeup of that portfolio, and feel good about just the overall management of it. And so we're kind of okay letting it run up a bit. I mean, that's if we're gonna let any part of the allocation kind of outpace the target, it would probably be U.S. large cap. I mean, that's just a core holding. We could probably lean down the EM part of the portfolio a little bit, and that's something that I'm having conversations with folks, just given kind of the added risk that we see around the world. It's a harder place to certainly a harder place to make money, and so if anything, thinking about maybe trimming that back a little bit. It just really hasn't been overly additive. I mean, it's given us some diversification. Our manager has done well on a relative basis, but just overall hard, getting harder to make money kind of within EM relative to the other asset classes. But I would say that could be something we do intra-quarter. But I'm looking at accounts right now and just kind of trying to make some of those decisions.
With the expected interest rate cuts, do you think there needs to be any change or recalibration with duration of the fixed income portfolio?
I'm going to stop sharing just for a second, just so I can see you all. So it is certainly something that was the reason why we changed bond managers. If you recall, we had Brown Advisory Intermediate Income as our bond manager. There are pretty tight restrictions within the investment policy statement from a credit rating perspective and credit quality perspective, and so we didn't have a lot of choices as far as adding high yield into the portfolio, or adding some kind of structured credit or any of that into the portfolio, just from a credit quality standpoint, which is okay. I think Voya has the credit quality that meets the standard of the investment policy statement, and they also have some credit within the portfolio, which is certainly boosting the overall yield of the portfolio. But certainly they within the portfolio are kind of managing duration within. So there's not much we can really add that's going to meet the credit quality standards for the town. So we're a little hamstrung on that perspective, but we are definitely we did lengthen duration going to this manager. So that was part of the move, was moving from the other manager that was kind of in the 4.5 year duration into like a 6 year type of duration. So a little bit longer, than the benchmark. So that certainly helped us in the fourth quarter, and we see the return, generation from that. There was definitely it was definitely some good timing. It was right before kind of the Fed, the Fed discussion. It was before the Fed discussion, and before we saw the 10-year go from 4.99%, to what 3.38, 3.9, that it went to. So we're able to capture all of that upside within the portfolio, and our duration, was the duration move that we made was really additive to the portfolio. So I think we've done that already. At this point, we like what Voya's doing within the portfolio from a diversification standpoint and from a duration standpoint. So I think we have enough diversification within that portfolio, and we'll allow them to kind of make those decisions.
Great.
Yeah.
Any other questions, comments from the committee or commissioners?
I also want to note that Eric Nelson is participating as a guest today, and I wanted to make sure that he felt comfortable participating whenever he felt like it.
All right, back to Dominic.
Yeah, I mean, we certainly go through, go through a little bit of the, sorry, I'm going to share my screen again. So I would just say overall, this is kind of a good chart to kind of just shows where we've been. December of 2021, really until December of 2023, we hadn't even gotten back to even on the S&P 500. So we just kind of broke above kind of that 2-year mark, where we had essentially 11 rate hikes that brought the market down. And then, we've seen this kind of steady kind of climb back out as inflation has, receded, and as certainly full employment, is certainly something the Fed has been looking at, right? I mean, that's their two mandates is to maintain inflation and to, have full employment. And so both of those are, certainly working in their favor. Along with the losing my train of thought here. Both of which are working, and certainly GDP print kind of being as strong as it was most recently. The U.S. economy is doing quite well. On a lot of metrics. I think there's still a lot of uncertainty, but the overall, by all accounts, we should have been in a recession by now. So, here we are. It's February 2024. I think a lot of economists had us either already going through a recession or leading into a recession this year. But we've been able to manage through the hiking cycle, and we've been able to continue to have full employment and have really good growth through this period of time. So the Fed has a decision to make. I mean, they've certainly alluded to three hikes this year, and I believe 4 hikes next year. But time will tell, and I think they have time. We'll probably not likely see a hike until the second half of the year. I'm sorry, a cut until the second half of the year. But that's certainly a lot of what's being priced into the market. Because if you look at kind of the overall, go to another slide here. If you look at kind of what drove markets this year, I mean, I think this is the calendar year breakdown of equity returns. It wasn't earnings growth that drove stocks. It was multiple expansion. And we saw that multiple compression, and we had these conversations a few years ago as interest rates were going up, multiples compressed and stock prices fell. Well, now we're seeing the opposite, right? The expectation that interest rates are going to fall. Now people are applying higher multiples on particular stocks, and that's ultimately what's driving. So the biggest 7 companies that we all know really generated 70% of the returns of the S&P 500 last year. 7 companies. Only 27 companies actually outperformed the S&P 500. 27 of the 500 companies in the index actually outperformed the index. So you can see that all of those companies, the largest companies, the Apples, the Microsofts, the Metas, were really driven by the AI boom. And still a lot of that has, some of it's come to fruition, but it's a lot of what we're seeing kind of across the board. I think the hope is that that a lot of companies that have managed through this period of time have tightened their balance sheets, have reset their employment, the employment metrics, they can come out of this and really start to grow again. And so, yes, we've seen multiple expansion. Will we see earnings growth catch up to it? I think that's certainly the question that we have. And, overall, earnings growth doesn't look great. I mean, there's certain sectors that look positive, but for the most part, a lot of earnings over year 23, 24 are actually down still for this year. So it's really a stock pickers market. I think it's why we like active management in this space, because it's now a time where, the haves and the have-nots, or the have, are really gonna separate themselves. And so really picking high quality stocks. And I think that's what we saw out of our Flex Equity team. Why we saw really good performance is because we have, bottom up fundamental analysts that are interviewing the companies, they're talking to them, really understand the business models and the drivers of performance, and really having a long-term view has continued to pay off. So, I think we, I would say as a firm, feel good about the overall state of the economy. I think we all, whether it's a soft landing or a no landing scenario, every day kind of goes by is kind of a lesser chance that we'll have some sort of major recession. And so we continue to look at the numbers. We're likely to bring down, rates pretty significantly over the next coming years. But, we have one thing different this time that we never had before, and that's really high US debt that we have to figure out. And I don't think everyone's really figured that out quite yet, but the cost of that debt is continuing to rise given the higher interest rates as this debt has to continue to get repriced. So that'll be certainly a question mark that people above our pay grade will have to figure out and at the Fed and in the Oval Office, but it will get figured out at some point. So our goal is to really focus on quality businesses and continue to invest in those businesses.
So two questions, Dominic. One, with multiple expansion already so high, does that counsel peeling back from those large cap companies? Because in other words, is there room to run still, or have we already exhausted it?
Yeah, there's less.
Second, corollary to that is seeing the Russell 2000 look pretty bad by comparison to the large caps. And with rates going down, is that a time to shift over to the smaller caps or mid caps?
Yeah, I think you're right, and certainly small caps for the first time in a long time outperformed large cap stocks in the fourth quarter, just for that reason, right? The thought is the cost of capital comes down, that should benefit smaller cap companies that have less access to liquidity, less access to capital. The Russell 2000 is a really tough index to gauge because there are so many companies inside of that index that don't make any money, that have no earnings. If you think about a biotech company that's in a phase 2 trial, all they're doing is spending money. They're not making any money yet. And so you have to be really careful. Certainly, having an active, really quality active manager in that space can certainly help. But really, we're looking for earnings growth at the end of the day, and so we are starting to see. I watch a lot of small cap companies, and there's definitely some good stories out there. There's some good stocks. There's some good companies that are now, they've had 2 years to kind of figure it out, and to really pressure was on for them to figure out their business. And I think what you're seeing is a lot of those companies, and that's not dissimilar to previous. Previous times, right? Anytime we kind of get a new rate reset, or a cycle reset, small cap tend to outperform in that period of time. So we are leaning a little bit into small caps, but I wouldn't say we're leaning in a large way. We're just kind of tiptoeing, adding a little bit on the margin. Because at the end of the day, these larger cap companies have so much market share, have so much cash coming in the door. They really have kind of that. It's hard to unseat them like it has. I mean, when you're talking multi-trillion-dollar companies that are out there, I mean, Nvidia went from few hundred billion-dollar company, and now they're a $1.7 trillion company within a year. I mean, it's astonishing to see what they've been able to produce, and that has been earnings growth. I mean, they actually have, because of what they're doing within the AI space, the GPU space. So it's not it's harder to just own the index today, the small cap index. You really want a good active manager in the space. I think we have one. I think they're doing a great job. And we can lean in, when the time is right a little bit more. But it's just stay in balance. It's why we have a balanced portfolio, because it's hard. It's almost impossible to time these scenarios. And so we're balanced, good managers, continue to outperform, and continue to just focus on the long term. We're not going to outperform every quarter or every year, but over the long term, as long as we kind of continue to outperform, we like how we're positioned.
Great. It's very helpful. Questions, comments from anyone else on the committee?
Brian, Eric put a question in the chat feature. If Kate can read that for us. He said he couldn't figure out how to do it otherwise. He's watching on YouTube using a chat feature. Does that make you watch me show technology knowledge?
No idea, unless Kate can read it.
It's not populating there.
Okay. I'll ask him to just send it to me directly. Others go on.
I don't think we have any other questions, unless Commissioner Persinger, any questions or comments?
Questions?
I think then we're just waiting on the one question from.
Okay, I sent the request. Since Commissioner Persinger is on the call as well, we have received month-to-month comparisons from Brown Advisory. Was that what you were asking for, to be able to see what was going on more minutely?
Was that question directed at me?
Yes, it was, sir.
Oh, I'm sorry.
We're now getting month-to-month information, not just the quarterly information, so we can compare, and that was something you had asked for.
Right, I think we've been getting that all along. I mean, I think there's some other questions related to, my concerns have been about the general fund, the short-term general fund position that we have, about $1.4 million. And, we dealt with this question at the last meeting to some extent. And the basic question is, should that be an investment or not? It's about 60%, maybe 2/3 of our rainy day fund, which has some requirements tied to the budget, and it's clear that because this is a fixed income investment at this point, at $1.4 million, it can go down, and it has gone down. If you look at certain periods of time, it has gone down. And so if you have to meet certain requirements, according to our general fund balance policy, is that a position that we want to be in? Do we want to have to deal with those time periods where this particular investment declines in value? The advantage of a savings account is that the principal never goes down. It may not go up very much, but you're not left with gaps that you have to fill through some other means in your budget process. So I think we have all of the information that we need. And I think, this committee, kick it back to the commissioners. We need to sit down and decide, should this be an investment or not? That's really the decision point that we're at this point with that $1.4 million.
And just for clarification, Gary, that's only 60% of that is in fixed income. The rest is in government bonds. I mean, that's in a 100% secured by the US government. So that's the savings account. I mean, a savings account's only going to be secured by 250,000 FDIC. So you really don't have insurance past that. So that is at risk.
Well, you would have to break it up.
Yeah.
You'd have to break it up into separate bundles in order to make sure that it is an insured amount of capital. And I didn't mean to say that the whole investment was fixed income, but it's certainly, that entire position does have the potential to go down in value.
Mhm.
And is that something that we want, since it is a key part of our general fund balance policy?
That sounds like a question that the council needs to decide and then put it in our guidance to our investment folks.
It is.
Because
Yes.
can't we simply, if you're concerned about losing the fund, any of the funds, moving it higher to government bonds, it's also a potential solution, isn't it?
Yeah.
I do.
I mean,
Yeah.
our money market's getting 5.3% right now, just sitting in cash. I think you also have to look at kind of the timing, right? We went through this rate hiking cycle that was the worst of my lifetime. 11 hikes in less than 2 years, and now we're looking at a falling rate cycle. So it's only going to be additive to the bond portfolio. So I just want to put that out there that I think we can telegraph this stuff a bit better, but I don't want to see you lose the opportunity to really make money within this fund by making a decision when rates are about to come down. So I think just put it into perspective of the broader economy.
Yeah, that's still part of is this an investment question?
Yeah, true. Fair.
Do we want to bear any risk at all for this amount of principal to go down? Or do we want to have, only upside, have that fund only increase? And it may not increase by very much, and it may increase over some period of time by much less than the current investment position would. But still, there's some growth there. And as our budget increases, if our budget increases by 10%, our rainy day fund has to increase by 10% as well. And we don't want to create an additional hole, I think, that we would have to fill through some other means. But that again, as Commissioner Gibbings just said, it's a question that commissioners need to sort out. And so far, we've kind of delayed it until we get some other analysis. I think there's a new banking proposal that is being considered, Bill.
Yeah, we have the RFPs are in. We've been working on the budget, so we have not reviewed those RFPs, but we will be getting to them sometime next week.
I have Eric's question, if I might. He says, does the fund performance versus benchmark include advisory fees?
Yes, it does.
Thank you.
Everything we show is net of fees.
I've shared this observation before. To Commissioner Persinger's point, if the budget expands, the rainy day fund has to expand with it, and you're going to give up all the upside that you are currently sitting on as interest rates fall. I asked Dominic about the duration of the fund. We went longer duration, which benefits us as those rates fall. So you can absolutely choose to go in a guaranteed or near guaranteed, will not shrink account by going into a money market or treasuries, but we have just come out of a zero interest rate environment. We know that there are going to be periods of time when that fund earns exactly zero or near zero. So you're sitting on an opportunity right now. If we're up to me, not the council, I don't think this is the time that you should be moving into accounts that pay much less. You have a lot of opportunity in front of you to have that fund grow along with the budget, but it's up to the council. There's obviously risk with everything.
Yeah, that's certainly good advice. Understood.
Yeah, I think you also have to factor in inflation. And if we're going to run at 2.5%, 3% inflation, you're going to a checking account getting nothing. You're actually losing 3% every year.
Any other comments or questions from committee or anyone present? Dominic, much appreciated. Thank you.
Thank you all. Appreciate it. Have a wonderful, wonderful weekend, everyone. We'll talk soon.
You as well.
Thanks.
Thank you all.
Thank you.
You're welcome.
I think the last item on our agenda is any other committee member comments? I will share my own then, which is that as I have informed the town, I intend to step down from the committee. Which means also stepping down from the chair position. So hopefully we will have a new chair appointed for the next upcoming meeting. It's been my pleasure to serve. I appreciate everybody's time and commitment to this, and thank you.
Thank you, Brian, for your service.
You've done a wonderful job.
Thank you.
And Brian, thank you for your time outside
Thanks.
of the meetings, helping me understand what it was I'd gotten myself into by serving as liaison.
Fair enough. Thank you.
Yes, Brian, thanks very much for your service. I appreciate you made a wonderful contribution to this committee.
Thank you. I think the last item on our agenda then is to adjourn. Do we
Could
have
we-
a motion? I'm sorry.
We have a gentleman in the room that wishes to speak.
Oh, very well.
Could you step up to the microphone, say your name and where you're from?
Your address, yes.
My name is Jim Deegan, 103 Hayden Road. With the recent announcement that they are going to run out of funds for the replenishment of the beach, where does this committee stand as far as talks or whatever with DENREC or whoever does this to see how much we may have to contribute?
Shall I speak to that?
I'm happy to jump in just to simply say I don't think that's the province of this committee.
you don't speak to
But
them.
I'll turn it over to the commissioners.
I have spent many hours with DENREC that I can't get back. My understanding is that they are looking at what beaches offer to the state and if that offering is worth support, which is a really weird way of saying, do we want beaches? My understanding is that DENREC is a cabinet position that lacks full authorization to do anything beyond the study. And my understanding from the SCAT meeting that I attended last night is the legislator, both at the state level and at the county level, and obviously at the municipal level, are not in support of the beach communities bearing the burden of the beach replenishment.
I'd
So
like to chime in. This is not really a beach replenishment. This is not an investment committee question at all. And I really don't want to even touch it, you know?
unless they were asking us to figure out how to come up with the funds to pay for it, which is what they were saying doing.
As far as you have a beach replacement fund that I thought this committee was in charge of.
So
then you need to figure out, okay, then how do we get those funds to a level to support that? That's why I'm asking.
Commissioner Gibbons, I'm happy to answer.
okay, one more thing and then I'll let you go. So it is misnamed when we talk about it here, because actually in the town paperwork, it's a beach maintenance fund. It's not a beach replenishment fund. So it's to do things to maintain the beach, which might be replenishment. If it's also sand dunes and cleaning up trash and lifeguards and such. But I want to let the chair speak. Sorry, Brian.
Sure. No, thank you, Commissioner. Seconding what Dennis observed, I mean, I don't think it's really up to this committee to make that determination. I mean, this is an investment committee. Our mandate is to oversee the investment advisor for the town. So the money that the town has allocated is what you have seen in the account statements. We've been discussing this evening the performance of the fund, which has outperformed its benchmarks within the mandate of the town's policy to invest the assets. It's generally performed quite well. And we talked about opportunities for potentially expanding or shrinking the ability of the funds to earn money. But it's really up to the budget committee to decide how much to budget, and up to the town council to determine how they want to pay for these things, such as raising taxes. So it's not really up to this committee to comment on it beyond that.
Correct.
Yeah, if I could just make a comment as well. I think if we were to be asked to contribute toward beach replenishment, then it would be at that time that the town council would reconsider the investment policy, and would come back to the investment committee with some different objectives and goals, and ask them to adjust the investment policy to meet those objectives and goals. But as of right now, we have an investment policy. The Brown Advisory is following it. And, we just got a good report on the returns that we're getting as a result of that policy. So I don't think there's anything to do, certainly at this point.
Any other questions or comments? Hearing none, I think the last item on our agenda is for adjournment. Do we have a motion to adjourn?
Should we adjourn before we have a chair for the next meeting?
I'm sorry, could you say that again?
Should we adjourn before a chair has been determined for the next meeting?
A temporary chair.
Before a temporary chair? Or shall we just confirm what the next meeting time is and determine a chair at that time, perhaps? Kate, how do we do this?
So you can go ahead and adjourn.
Yes.
We can go ahead and put on the record when the next meeting is. The town council would have to approve the appointment of our chairperson anyway. So if you as liaison would like to work with the committee after this meeting and see if someone would like to nominate or nominate themselves to be the chair, then we can get that figured out afterwards and
Fair.
get the town council's approval.
Got it. And our next investment committee is now scheduled for, you got it on your calendar?
It should be April the 11th, I believe it's second Thursday of the quarter.
Okay, yes. Everybody got that marked on your calendars?
April 11.
April 11, 5 o'clock here or there. One person here. I
Okay.
apologize for getting in your way of trying to adjourn us.
I think we're ready for a motion to adjourn then.
Motion to adjourn.
Motion to adjourn.
Okay.
Second.
Second.
Or a second. All in favor? Aye.
Aye.
It is unanimous. Appreciate everybody's time. It's 5:45 p.m. and the committee is adjourned.
We'll miss you.
Thank you,
Thank
Brian.
you.
Thanks, Brian.
Thank you very much. Appreciate it.